Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure to recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Good evening to all our online viewers. Hello everyone. Today is Friday, December 19th, the last trading day of the week. We'll be focusing on the following 2 topics, along with some related information to share with you all. First, have tech stocks already bottomed out in the short term, and are they getting ready to rally? That's our first topic for today. The second topic is about Japan's interest rate hike and rising sun in the east. What's the connection between the two? We'll explain everything to you one by one. Alright, first, let's get into today's main topic. Yesterday, the CPI was released, along with Micron's earnings report, so the market sentiment is already quite different from the first 3 trading days of this week, or even last Friday. It was mentioned here that despite the limitations on related data due to the government shutdown, stock traders and institutional analysts still welcome the slowest increase in consumer prices since early 2020 and 2021. Alright everyone, take a look at these new charts. Not all of them, but especially the tech giants. In particular, Micron, which is a leading indicator company, has given an optimistic outlook for its future performance. Because of this, the S&P index ended its 4-day losing streak, which is quite different from before. Here, we can see the core CPI. If we look at the general CPI, it's an annual increase of 2.7%, while the core CPI is 2.6. Both are lower than the market expectations of 3.1 and 3.0. So as you can see from the chart, this is the lowest level since 2021. So yesterday, after the CPI was released, the futures market was the first to rally. Then, after the cash market opened at 10:30, it also showed a relatively strong performance, although in the short term, there was some back and forth between the bulls and bears. But overall, by the close, the market was relatively stronger compared to the previous few days. Alright, let's take a look at the key stocks that were announced yesterday. NU Holdings' earnings report from the US side closed up by 10.21%, and it kept climbing from the 20-day and 50-day moving averages that we mentioned yesterday. Although there was some selling pressure during the session, it didn't break the bullish trend. Alright, let's look at something else. Also, the US president keeps making statements. I believe this will go on for quite a while, because he seems to really enjoy the process. Every day, reporters keep asking him, when will the Federal Reserve Chair be announced? Who are you leaning towards right now? And he just says, he still needs to interview 3 to 4 candidates for the Federal Reserve Chair position, and then he'll quickly decide who to nominate. Actually, if there ends up being a 5th candidate, it wouldn't be too surprising. Why is that? Because he's just looking for people within a few core circles, whether it's Wash, Hassett, or people like Waller. Among these, even Bowman has come up. So if there are any new candidates, there's really no need for everyone to be surprised. I think it's something special, because he just wants everyone to keep asking about this. He said he thinks everyone is a great choice. Of course, if they weren't, they wouldn't even be able to get into this core circle. Alright, and he also said that in the coming weeks, or he might announce the candidate before the end of the year. He said in the coming weeks. We've actually been hearing this in the coming weeks for a while now. He's still saying we should pay attention in the coming weeks. Last time when his term was announced, it was around early November, and now it's already the end of December. I believe this timeline will keep getting pushed back, maybe even into early January. Alright, let's take another look at Trump. Based on his own business development history, he really is someone who makes decisions very flexibly. He himself has emphasized this many times. Just yesterday, regarding his company, the companies he owns, and these tech companies, EAE Technologies, a company focused on fusion energy, announced that the 2 sides are going to merge. After the merger, the combined valuation will exceed $6 billion. This changes the fate of DJT. Originally, this was the parent company of his social media platform, but the company has been losing money all along, even though they previously announced plans to enter the cryptocurrency space and related areas. Whether it's funds or related asset market platforms, none of them have been able to save its ugly financial numbers. What I'm saying here is, in fact, it originally had almost no room for growth. So what about Trump? He actually holds this through a trust fund managed by his son-in-law, holding more than $1 billion worth of shares. Yesterday, overnight, it shot up by 41.93%. That's DJT. Even though it went up so much in just one day, if we compare it to the beginning of the year, or since he took office, the stock price back then was around the $30 to $40 range. Actually, it's already dropped by more than half. You could even say it's lost 70%, and that wouldn't be an exaggeration. Only 30% is left, not stacked in 3 layers, so yesterday's 41.93% increase was indeed a small consolation. We can also marvel at Trump's deal-making skills. This deal is really a classic case of 2 companies each getting what they need. Because Trump knows he needs a story to drive the stock price up, but for this merged company, what they really need is political support or resources or help from people connected to the Washington, D.C. and White House circles. So we can see that Trump really does have his strengths in this area. But on the other hand, as president, how do the American people actually feel about his policies? Or you could say, how satisfied are they with his performance? Since January of this year, the approval rating for his administration was still above 52%, around 50 to 52%. Of course, it's normal to have that kind of momentum right after being elected or just taking office, but as issues like tariffs started coming up one after another, and even the stock market began to fall, you can see that from early April, his approval rating has been on a steady decline. The poll numbers dropped by the end of April. After a brief rebound in early May, then in October and November, especially with the news about the government shutdown at that time, well, during the first year, starting from the end of October, the shutdown lasted through all of November. And as related news kept coming out, the poll numbers stayed relatively low. Recently, there's been a bit of a recovery. Actually, if you compare it to the previous chart, don't you think the trend looks almost identical? You could even say it's basically the same, meaning his poll numbers and this trend are closely linked. The performance of the stock price is actually very similar. Alright, let's take a look at today's first topic. Have tech stocks hit bottom in the short term, and are they about to go up? Bank of America pointed out that investors are pouring into the US stock market at nearly record speed, injecting funds, continuously buying in. Whenever there's a dip, they buy. Buying the dip, consistently buying at lower prices. Why are they doing this? It's in preparation for the expected drop in borrowing costs, lower tariffs, and tax cuts coming in 2026. Here, he cites EPFR's global data, saying that as of the 17th, nearly $78 billion flowed into the US stock market that week. Actually, this is very likely a result of the market hitting new highs last Wednesday and Thursday, with large amounts of capital continuously flowing in. Also, since the record $82.2 billion inflow last year, it's been a weekly occurrence. This is the largest scale of capital inflow, so indeed, there has been a continuous stream of funds. Where is this money coming from? I believe it's pouring in from all over the world, not just from American investors or institutions or individual investors. Actually, I believe it's coming from everywhere, because as everyone knows, the US stock market is famous for its long-term upward trend, so this isn't surprising at all. Some people prefer individual stocks, some like ETFs, it doesn't matter. The point is, funds keep flowing in. On the other hand, Goldman Sachs Group analyst Neither, in his strategy, is optimistic about US stocks. He says that with strong economic growth and a weakening dollar as support, the S&P 500 index will rise next year, that is, in 2026. It's expected to go up by 12%. In addition, Bank of America's strategy, which is also quite well known, says that the bull market in stocks is related to 3 factors. What are those? The economy will be booming in 2026. Interest rates will go down, which we've already mentioned before. We've mentioned this quite a few times, and tariffs will also go down. But let's set that aside for now. As for how the Supreme Court will rule on these tariffs, well, that's still uncertain. But the belief is that Trump won't keep pushing for such sharp tariff policies, especially like the ones in April this year that were so tough on countries around the world. This is clearly a trend in development. Sure, there might still be some tariffs on the surface, but in reality, it probably won't be like before, especially not the tit-for-tat retaliation we saw with China. On the other hand, there's also the matter of taxes. The reduction in taxes might benefit businesses. For most companies, this is a good thing, because they might be able to save on some related tax expenses. Now, let's take a look at the NASDAQ 100. Among the 3 major indexes yesterday, it performed relatively well, and it's mainly related to tech stocks. Let's take a look. What a coincidence! This blue line here is the 100-day moving average. The last time it was around this area, there was quite a bit of buying activity. So is it going to be the same this time? We can keep a close eye on it today and see. Why? Because it's related to the second topic, which we'll talk about in a bit. Alright, let's keep going. If we're talking about technology-themed ETFs, which ones are there? This is one of them, XLK. When we look up its main holdings, the biggest ones are of course the names everyone knows: Nvidia, Apple, Microsoft, Broadcom, Frontier, and Arista. These are all familiar to us. Today though, we can also take a look at some of the ones further down the list, especially Cisco and IBM. These two, because the others have already been covered quite a lot by mainstream media, and even on our own channel. So today, let's focus on Cisco and IBM. The respective weights are 2.76% and 2.53%. If we look at the profit forecast on Bloomberg, let's start with Cisco. CSGO. So as for their Q2 results, the ones already announced are shown up to the blue section here, which have been reported. Looking ahead to Q3 and Q4, Q2 is of course the latest financial report, so we keep looking forward. Overall, the numbers are pretty standard and steady. If we compare it this way, it's about an 8% year-over-year increase, assuming their estimates are accurate. Of course, these numbers could still change in the future, but for now, this is the current situation. Looking ahead to 2028, it's also roughly around 7 to 8%. Alright, let's take a look at Cisco, at how Cisco's stock price has been performing. Actually, speaking of that, it's actually not weak at all, especially if you look at its recent consolidation, which lasted until mid-October. That is, after rising from June or July up to early October, it started consolidating, but after mid-October, it began to climb again. And then, recently, it's been taking a bit of a breather. But it hasn't even broken below the 50-day moving average. That's how its current stock price is performing. On the other hand, let's take a look at Bloomberg's forecast for IBM, the so-called Big Blue. So how has it been doing lately? Looking at the numbers already released for 2025, you can see that performance has actually started to heat up compared to before, whether it's the earnings figures of 2.8 or 2.65. Also, in the latest fiscal quarter, which might be its traditional peak season, you can see that. This so-called Q4 of their fiscal year has also performed quite well, and looking ahead to 2026 and 2027, it's actually relatively stable, with a consistently positive trend. Each year, they might earn around 12.2 to 12.9 per share. As for future projections, it will depend on the latest developments in the industry. In fact, they even have a place in the field of quantum computing, continuing to deepen their roots in this technology. Alright, let's take another look. Recently, IBM, well, since the end of August, has started to see, of course in the short term, some strong buying momentum. After its stock price rose to $320 in November, it took a bit of a breather. Over the past month or two, it's been resting, but there hasn't been any obvious weakness. You could say it's been consolidating within a range. Yesterday, its closing price dropped by 0.95%. Of course, yesterday, most tech stocks were generally up rather than down, so IBM wasn't particularly strong. But we can keep an eye on its upcoming trend to see if, thanks to its solid profit forecasts, its valuation can continue to rise. Alright, next let's look at today's summary table. What we see here is the group of tech giants, specifically those in the sub-$1 trillion market cap club. Of course, there's one company in there that's not really related to tech, and that's Berkshire Hathaway. At most, it just holds some tech stocks. Recently, its core holdings have included Google, but previously, as everyone knows, it was more traditional, with Apple. There are also many other traditional industries, like insurance, railroads, Coca-Cola, American Express, and various financial stocks such as Bank of America. So today, it's actually quite unique. We can see here, why do we have these two columns, the average purchase yield over 3 years and the total return, placed here? It's because I want to discuss this topic with everyone first. Looking at the purchase yield, if it's relatively high, and of course we're taking the 3-year average here, you might say that recently some of these. The net profit margin has already increased, but that's okay. It still has some impact, of course. But by looking at the 3-year average, we can get a sense of the company's industry position and profitability over the past 3 years. First, you can see who has the highest rate. It's as high as 40%. This purchase yield means that for every dollar of revenue, you can turn it into $0.4 of net profit, which is pretty remarkable. Alright, and besides that, we can see that another strong performer here is Meta L. Now, does this have anything to do with its year-to-date returns? Well, to some extent, yes. Since the beginning of the year, NVIDIA has risen by 29.71%. But AMD is even more impressive. Although its average net profit margin over the past 3 years isn't as high as NVIDIA's, its year-to-date increase is 43.31%, which is pretty remarkable. There's also another one that's really worth noting. This one has the highest return so far this year at 60.41%. The one that took the lead is Google, but each of them has their own unique story. In fact, if we look at the top two, these are currently the biggest players in the GPU space, the ones that are either trying to replace or catch up to the leader. The competitors like Google have their so-called tensor processing units, and they keep working on them. Whether it's Google, Amazon, or related companies like OpenAI, they are all continuously developing ASIC chips. So what does this lead to? Their stock prices have actually shown explosive growth this year. In fact, as we just saw, well, actually on Monday, everyone saw it too, the highs and lows might not be that important anymore, because now you know they're already part of the trillion-dollar club. That means the majority of investors, whether individuals or institutions, are continuing to buy into them, because if you don't buy them, you really don't know who will come out on top in the future of AI. At most, there's OpenAI, but it's not publicly listed, so you can't invest in it either. So you can't actually go and buy it directly, which means you might only be able to buy some related companies. For example, maybe those connected to Microsoft, since they've been investing in it for a long time, and so on. But Microsoft also has its own core business. All right, so this page is just for your reference. You can see its position in the industry, and over the past 3 years, how it has turned $1 of revenue into net profit, as well as the ratio between the two. All right, next, let's take a look at the companies that Bloomberg is focusing on. Actually, Bloomberg Industry Research has mentioned this. They have a list of 50 companies that they are paying special attention to for 2026. This list is quite extensive, covering companies from the US, Asia, and Europe. They say that from the tech industry to traditional industries, artificial intelligence is a key driving force. They've been observing this for a long time. Now, let's take a closer look at one of these companies. DT is a holding company that, through its subsidiaries, develops enterprise cloud software intelligence platforms. This allows clients to move toward modernized and automated technology operations. Additionally, they develop and launch high-quality software that can improve user experience and achieve better business performance. All right, let's take a look at its profit estimates. It has already announced 0.33, which was from before, and this year's is 0.42. Looking ahead, it's gradually increasing year by year. Although we've never seen explosive growth, you can tell that it's steadily moving upward. But in the next 2 years, can it break through $2 per share? As for its stock price, previously it went above $56, but then it gradually declined and consolidated. Recently, it's been hovering around $40, between $40 and $45. All right, let's look at its closing price change yesterday, which was 0.61%. Now let's move on to another company, EM, which is Emerson Electric. Speaking of electricity, it's also related to computing power and power infrastructure. They design and manufacture electronic and electrical equipment. This company, in addition to managing power grids and industrial automation, even offers climate-related technologies that help industrial companies and commercial consumer markets around the world by providing its products. Now, let's take another look, similarly, at its profit forecast. The previously announced figures are here, the blue ones, 1.38 and 1.48. You can see that its quarterly profits are actually very stable, with hardly any major surprises, and you could say there are a few unexpected positive results as well. That's right, and it's steadily moving toward 2262, 72.8, step by step. Of course, I think the current analyst forecasts are pretty neutral. They're not even what you'd call optimistic, but you can see its annual profit growth, which might go from 6.48 to 7.05. Then up to 7.77, gradually increasing. Actually, relatively speaking, this trend looks pretty clear. As for ENR's stock price chart, since August, we've seen it fluctuating within a narrow range. By September, October, and December, it only widened a little bit. Yesterday, its price change wasn't significant. It dipped slightly by 0.03%. All right, let's move on to today's second topic. What is our second topic today? The Bank of Japan announced an interest rate hike today. Actually, during their statement, there was a lot of caution and ambiguity, but we can still pick up on a few signals about what they might do next. All right, so the governor, under whose leadership the policy committee agreed to raise the policy rate by 1.5 basis points to 0.75%. That is from 0.5 up to 0.75. What did he say? He said that the rate hike cycle will continue, and if the economic outlook materializes, he will keep raising borrowing costs. The possibility of that is increasing. Of course, he spoke in a rather cautious manner. He said that the pace of interest rate adjustments will depend on the state of the economy and the level of prices. That's true. Now, let's look at the key point here. He said that the Bank of Japan expects the neutral interest rate to be between 1% and 2.5%. So if we look at it from the most conservative perspective and assume it's 1%, then raising it to 0.75 now is basically telling everyone in the world that in the end, at the very least, if they're aiming to get close to the neutral rate, they will have to raise it at least one more time. So this is like knowing that the sun will rise in the east, but you don't know if it will be at 5:30, 6 o'clock, or 6:30. Honestly, it doesn't really matter because you know it will rise eventually. Of course, the timing and the way the rate is raised will continue to be communicated to the market. Because as we can see over the past 2 weeks, whether it's in Europe or the US, this topic has already been under discussion. And if you look at Bloomberg news related to Japan, there are even more reports about it. So clearly the financial sector in Japan has already considered this as something expected and reasonable. Of course, there's nothing surprising about this. Here, it mentions that the current interest rate, even if it's raised to 0.75%, would still be some distance below the lower end of the forecast range by CITIC Securities. So this is something that will happen in the future. From our perspective, some people talk about arbitrage trading or so-called carry trades. What happens is, previously, people would get into the yen when interest rates were low, and then move their money to high-yield places like the US or Australia. They'd buy things like US Treasury bonds or American tech growth stocks, knowing that this kind of strategy, the returns could be explosive, and the cost of capital is almost zero, if it really is that low. Then, when it comes time to unwind these carry trades, wouldn't US Treasury bonds be the first to take a hit? Or maybe even US stocks have already started to pull back in advance. If we look at the US Treasury Bond ETF, TLT, which tracks bonds with maturities over 20 years, that's actually the case. But that's only part of the story. We can see that, assuming the previous day's closing price was $88.22, the drop from the earlier peak of $92 is about 4 to 5%. Yesterday's increase was 0.48%. You could say that during this period, everyone already knew that the Bank of Japan was about to raise interest rates. So do you think these institutions and investors would wait until today, after it actually happens, to react? They would only pull out their funds and close their positions after the fact, right? Well, probably not. Many investors or institutions had already started selling in advance, which is why in the short term, this ETF has continued to see capital outflows, and as a result, the stock price. So for this sector, there's basically been almost no gains. It's just been consolidating slightly and staying weak. So it's more of a slow decline. Now, if you ask whether the drop is significant, a 4 or 5% dip is actually within an acceptable range. Plus, back in July and August, it wasn't performing like this at all. Alright, let's take a look at the US stock market. It's pretty much the same story. After hitting new highs last Wednesday and Thursday, it started to trend down from Friday. But if you look, we haven't even touched the deep blue 100-day moving average yet. So today's a really good indicator to watch. Will there be selling pressure like last Friday? Plus, today there was a major decision announced. The Bank of Japan raised interest rates, bringing them up to 0.75%. I mentioned this to everyone yesterday. As for Japan's yield, or rather a couple of days ago when it approached 2%, it actually hit a multi-year high, but even after it reached 2%, the market's sense of panic didn't really increase as a result. In fact, the stock market had already priced in this reaction ahead of time. Now it actually seems more likely that the negative news has already been fully digested. Also, today I noticed that everyone has been talking about the AI bubble theory for several days, but the market still hasn't dropped. And as for the Bank of Japan raising interest rates, that's been discussed for days too, but the decline has only been this limited. It seems like there's nothing left that could serve as a reason to sell, so the market just keeps getting stronger. Buy in and ride the upward trend online to welcome the Christmas rally. Alright, let's take a look at the S&P 500 and its sectors. We're looking at the performance from December 11th to 18th, which is the past week. Among the sectors, the stronger ones are auto manufacturing, metals and glass, apparel and accessories, and also food and beverage. These are considered more niche industries, or you could even say they're more essential. There's also tobacco and wireless telecom. So that's how things stand this week. The ones that dropped more than 2% are mainly those that performed worse, especially before the Bank of Japan raised interest rates, and also under the concerns about an AI bubble. With these worries, some funds were adjusted, for example in semiconductors and electronic components. Even in areas like crude oil, natural gas, heavy electrical equipment, and various related stocks, their performance started to weaken. Now, let's take a look at a report from Hombo Economic Research, which points out that the CPI report could affect the rate cuts next year. It might end up being more than what is currently expected this year. Let's start from the beginning and take a look. For most categories of goods affected by tariffs, inflation has already peaked or is about to reach its bottom, meaning we've basically seen the highest point. Next, during the November holiday sales period, it'll start to decline. For example, Thanksgiving and then Christmas. Here, we can see that food prices have surged, but in the past 2 months, the increase has slowed down dramatically. In other words, prices have almost stopped rising and have started to gradually go down, or at least aren't rising as quickly. So what about inflation? In the next few months, it might continue to decrease, and we already saw signs of that yesterday. The annual rate is 2.7%, and the core rate is actually 2.6%, both much lower than market expectations. If this trend continues and gets closer to the Fed's 2% target, then the Fed will only need to focus on employment going forward. People are saying that the jobs data might continue to show weakness. So what does this combination mean for the two sides of the scale? One side is maximizing employment, and the other is controlling inflation. If inflation is already clearly under control, then the next step is to quickly focus on employment. If employment continues to show very negative numbers, then these officials might start to get a bit nervous, because one of their tasks is to maximize employment. The stance most likely to lead to rate cuts will become even clearer. As for some of the more hawkish officials, some of them have said they're still waiting for more data, so they might not be as tough as before. So here, the Bloomberg economics team is predicting that the Federal Reserve will cut rates by a total of 100 basis points by 2026, which is 4 rate cuts, more than the current forecast of just over 2 cuts. That's their estimate for your reference. Since we just mentioned core consumer goods and food-related items, let's take a look at that now. In there, it mentions a lot of companies related to supermarkets and daily necessities. Let's talk about Costco, ticker symbol COST. It has the second largest weighting in the group, accounting for 8.62%. It's one of the main constituent stocks in this group. All right, let's take a look. Costco dropped by 0.59% yesterday. We can see that since it previously hit 1,000, it's fallen to yesterday's closing price of 857.59. Actually, its highest point was around 1,060. So if you do the math, the pullback is just about between 19 and 20%. In other words, if it keeps dropping, if it doesn't find support here and continues to fall, then what does that mean? It would then enter the definition of a short-term bear market. As for whether today or next week it can hold this downward trend, or if there's a chance it could reverse and rally upward, we'll have to see if the Christmas shopping season's consumer spending is as strong as expected. Because people always say Christmas is the peak season, but is that really the case this year? Let's take a look at this. As for profit estimates, again, based on the latest numbers released, it's 4.5 for this quarter, and it continues to rise quarter by quarter. If we look at it on a yearly basis, it's also steadily increasing. Now, for the next point, during the same period, for the same period next year, the estimate might be 4.79, and for the year after that, 5.3. So is the stock price really dropping? In fact, in the short term, these profit estimates aren't really affected. All right, and actually, if we look at the annual numbers from 14, 14.68, 8.21, 12, 12.24, they're all relatively stable. I don't know if you've ever been, but in Taiwan, even if you haven't been to Costco, you've probably seen how packed it gets with people. So you can tell that at least in Taiwan, it's still extremely popular. In the US, because there are many local competitors, like say Kroger and other similar large supermarkets, there are also a lot of them. So if you just look at the overall profit and earnings estimates, its performance is actually quite solid. And these are also comprehensive indicators provided by mainstream Wall Street brokerage firms. So you can see that. As for its future prospects, there's really no need to worry too much. Just pay attention to how far its stock price corrects. If you truly believe that this core consumer stock should be a part of your investment portfolio, then that's something to consider. You don't have to commit right away. Just think it over. Keep gathering more information to analyze what direction it might take next. Now, as for the company earnings reports coming out this week, we have Nike and FedEx. We'll talk about Nike's situation a bit later today. Next, let's take a look at some international news. EU leaders have agreed to lend Ukraine 90 billion euros, over 100 billion US dollars, over the next 2 years. This is meant to strengthen Ukraine's bargaining power at the negotiating table, because Russia's ambitions are not going to stop. So they will only continue to nibble away at Ukraine's territory, and right now they're just trying to take as much as they can from the current front line. Okay, so in this situation, as long as one side is unwilling to stop, no matter how much Ukraine, the US, or Europe want a ceasefire, it's just not possible. All right, let's look at how the EU plans to raise joint debt through the capital markets. In other words, a lot of banks and financial institutions will help raise these funds and participate. So who will guarantee this fundraising? It will be backed by the EU budget, so there is an official guarantee. They will act as the backing to provide funds for this loan. Previously, that wasn't what they said. Earlier, they said they would use the frozen Russian assets in Europe to provide funds for Ukraine's reconstruction or related needs. However, because of Belgium's position, they just aren't willing to agree. So that's pretty normal, because Belgium is the main country holding these assets. If they really used them, then of course Russia could see it as an act of appropriation, or even illegal misappropriation. So this is a major shift. And now they've come up with a new approach. So raising joint debt in the capital market, basically someone needs to issue this kind of debt. For Ukraine, if later on, say, the war really ends or there's a ceasefire, then they can pay it back more slowly. Or one of the conditions here is that if Russia were to provide some compensation for this incident, then it could work. But as for whether that's likely, I don't think the chances are high. All right, let's take a look at the European Financial ETF, EUFN. Its recent stock price performance has been very strong. Yesterday, it even rose by 0.91%, reaching a new high recently. Actually, if you look at it since July, it started at just over 30. All right, it has gradually climbed to 34, 35, and yesterday it even reached 36. So that's about a 20% increase. You can check it out. Next, let's look at some international stock markets and investment news. Reportedly, China has developed its first prototype of cutting-edge appearance technology. So what about their engineering team? They used reverse engineering methods, and some of their previous engineers actually worked at ASML. In other words, after they left the company. So why did they end up working for China after leaving? Because, according to EU privacy laws, ASML actually isn't really allowed to track the movements of these former employees. So if you can't track them, you really have no control over where they end up working, right? Okay, so this shows that China has made substantial progress in producing cutting-edge semiconductors. But is that really the case? Let's take a look at the extreme ultraviolet light generated by this circular mark. Indeed, they might have even made good use of some methods, hoping to amplify the power or the light. Yeah, this intensity is enhanced. They even changed some methods, even altered the size of the equipment. But he says that this is a completely different matter from actually producing chips. Why? Because the original extreme ultraviolet light was made by ASML, and it took them almost 20 years, from the first prototype to being able to commercialize production. Only after commercial production can they supply companies like TSMC, which are involved in advanced semiconductor manufacturing. In other words, if this machine doesn't work, or if it's still being improved, it's very difficult to provide it to semiconductor companies like Huawei or ZTE. Also, they haven't disclosed information like the light source power or the normal operating time. Even if we assume they can quickly overcome these hurdles, let's say they cut the time in half, it would still take about 10 years. Oh, if they move even faster, let's say they double the speed and do it in 5 years, that would be the absolute fastest. If they manage to cross that threshold in 5 years, then the time when tech stocks get surpassed is still a ways off, so there's still time to wait. So at this point, this is still something unproven, and their mass production capability is also uncertain. It's just that this is happening and everyone should just be aware of it for now. Alright, let's take another look. Actually, recently it's still following the trend of tech stocks and consolidating a bit downward. Today we can look at this kind of news again. Honestly, I think all the negative news has gradually faded and become less impactful, so whether it will keep dropping is still up in the air. Since September, though, the upward trend has been pretty clear. This can also be considered a previous starting point for the rise in tech stocks. Alright, let's take another look at the pre-market gainers and losers in the US stock market. First, looking at the pre-market, Oracle has already gone up by 5.57%. Of course, this is as of 7/12, and companies related to Albemarle and lithium mining are also on the list. As for Nike, because it released its earnings report, its pre-market performance is relatively weak. Let's take a look. This is Nike. Today, it announced that due to a sluggish market in China and underperformance of its Converse brand, sales haven't been very strong. Although this quarter's sales are still expected to decline, and as a result, the pre-market stock price has started to drop. They said that for the 3 months starting from December 1st, revenue will see a single-digit percentage decrease, that is possibly within the range of about 7 to 10%. Such a decline is quite a surprising shift compared to its previous growth. So after the market opens at 10:30 on the 8th, its stock price may be relatively weak. Everyone should pay attention to that. Alright, that's all for today's You Want a Cybersecurity update. I wish all our investor friends smooth trading this Friday. See you next week. Bye-bye.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.